Welcome back to Investment Fund Analysis. Today we're going to speak about Emerging Market Debt Fund. Dear investor, welcome back. So we are going to talk today about a category in the space of fixed income funds, Emerging Market Debt Fund, that particularly suffered during the crisis of March, and that could be maybe back in fashion if situation is calming down. As you can see, there were huge devaluation of emerging market currencies against the US dollar during the crisis. Money came out of these funds, came out of emerging markets, and this created a huge drop in prices in emerging market debt. Here we have a selection of some of the big emerging market debt fund, some big houses like Goldman Sachs, JP Morgan, UBS, BNP, and the Pictet Emerging Local Currency Debt Fund. And as you can see, they are still down since the beginning of the year in between 6 and 8%. But during the crisis, during the month of March, some of these funds have been as much as 20% down. So a big capital losses. And some people, got scared and got out. At that time, it was the market, completely crashing. I think that maybe right now it could be interesting to look at them again. As you know, markets are stabilized. Fixed income in main markets, due to central bank intervention, are having their yield very, very low. So people can go back to emerging market debt, can go back to the famous carry trades in between some of the currencies like Mexican pesos, even Brazilian real. Now they look attractive in nominal yield and in spread against the dollar or against the euro. Investor could come back. Now looking at, as I was saying, some of these funds, they are mostly long, and the dispersion in terms of performance has been relatively low. This means that managers were sticking to their benchmark, and unfortunately they were going through the crisis fully invested, and they were not really too much active on it. And if you can see very well also on the chart that all of them practically they reacted in the same way. This is what we rather don't like, too much. We like, manager that maybe can come out of the crowd and reduce the drawdowns or have a fast recovery. In this situation, as you can see, whoever of the funds you would have chosen, even if they are completely different, sometimes styles, but they had a very, very, very similar performance. I would rather say that any of these funds will probably give you the right exposure, and it's still better to be invested in a fund than a do-it-yourself and choose some bonds locally. So diversification matters in terms of countries, in terms of currencies, and I think that any investor that is looking at allocating some funds to emerging market debt could look at one of these funds. Thank you very much, and have a good day.